Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So I'm back in the saddle following my trip to San Francisco for the World AgTech Forum, or World AgTech Conference. I was able to speak at it. It was a good conference. It just took a lot of time to get there. Flying is terrible, and I'm just officially a Griswold. And if you ever find out I'm on the same flight as you, change your flight because you'll be guaranteed to be late. But so today we're going to talk about what's happening in the oil patch, what's happening with spreads, what's happening with rigs, and then we want to look at some of the things that have been happening, obviously on the financial side, as well as some of the data that came out while I was away. So getting right into it, you can see that we had a nice increase in completion crews from 276 to 290. So it's important to understand, because you might be looking at this and be like, well, why was there such a huge spike in activity? Well, we had a bit of an increase in rig counts, and we'll talk about that in a minute. But we normally have a bump, and it normally happens in March, sometimes first week of April, where you get this pivot higher in terms of just activity, getting ready for spring, pulling some of this additional equipment in. And if you remember, we kept saying that we should be anywhere between 285 and 287, and here we are now at 290. So again, we just closed that gap. Now, the moves going up from here are going to be much slower because then you're going to have some weather. It's going to be cold in some areas, some snow sticking around. So that'll keep things a bit consolidated in terms of where we see some of the different pieces. But again, getting to this point was where we thought we were going to be by the end of the month, if not the first week of April. Now, we could easily come back down a bit, to 285, but realistically, from this point until the end of the month, first 2 weeks of next month, we should be between that 285 and 293 level, just as things move around and we get into that mode, getting prepared for that June, July push. So realistically, we had increases across the board. We had Anadarko, Appalachia. Those were fairly small. The Permian saw the biggest, which is not surprising just given where it is. Same with Western Gulf. And it's just you're seeing a lot of that activity come back into Texas. You're seeing a lot of those completions starting back up, which is, again, very normal for this time of year. So it's not like, they're coming in to crush the crude price. It's like, no, this is typically when we start to see a lot of this activity picking back up. So now when we look at rig counts, we had an increase of 9 in gas, decrease of 1 in oil. But as we always say, you want to look at where was it coming in, and you can see horizontals were held flat. Directional was up by 5, vertical was up by 3. So the vertical going up typically means that once you have the vertical go, a week or two later, you're going to have that increase in horizontal. And remember, we've talked about, and we showed the chart, I believe it was in the insights, on the spreads, the spread between rigs and completion crews. And we had to start to see some of that balance out. And that's this balancing out, where you're starting to see some of these movements and things getting fairly stable as we go into the spring increase. Now, when we look at the global side, so Russia diesel continues to surge. The floating storage of diesel from Russia is approaching 6 million barrels. And this is exactly what we were talking about, which is why we saw pressure coming into the Middle East, into Singapore, when you look at the amount of product that is going to come into the market, which is why we expected to see some increases in storage in both Fujairah as well as in Singapore. Russia seaborne crude shipments are fairly stable. And this is what we've been talking about, that even if Russia were to decrease their production to the level they guided to, which so far it looks like it's closer to 350, not the 500, that they were still going to keep their seaborne crude levels the same, because the reason why they're cutting their production is because they can't operate their refiners at the same level, just because they don't have enough storage. And now look at the amount of diesel sitting in ships. So they have to balance that somehow. And the way to do that is to reduce run rates But if you reduce run rates, that crude has to go somewhere, and it's going, and that's why they're maintaining it, which is why we've said even as they reduce production, they're still going to be able to maintain their exports. And it's no surprise to see China and India have been big buyers. That's not something that we see changing. India has actually increased recently, which is taking advantage of the pricing spreads. But so far in March, we've started to see a slowdown in refined product purchases on a month over month as well as a year over year level, which is in line with some of the slowdowns that we were expecting, driven based on economic activity, globally speaking, as well as inflationary pressures within India. Now, when we look at driving data, you can see Asia Pacific ex-China still very weak. North America, same thing, kind of sitting there. But Europe got much stronger. That's something that we typically kind of get a spike and then a fade. We see that playing out, but again, Europe kind of staying fairly elevated at this point in time. There are a lot of strikes happening there right now, which is really kind of throwing off a lot of the refining side. And that's going to result in some additional draws from the refining front. But in general, when you look at Asia Pacific, North America, that's where we continue to see the weakness on the driving front. China is weakening, but again, as we said, it's going to weaken along seasonal lines, just at a higher level, like just because everything's open. So that's what things are moving downward, but still, again, strong versus last year. And we don't really see that changing. We see it staying fairly strong from this point forward, just at that elevated level. Now, when we look at storage, you can see Singapore had a big increase with increases across the board. Light distillate still setting records. Middle distillate is the one that we've been saying to watch because middle distillate has been seeing those levels. And then when you look at Europe, draws across the board, and that's something we're gonna likely get more draws as these French strikes continue to roll out. Now, we had some of the inflation data when I was gone, and not surprisingly, the inflation data was fairly strong. And the reason why it was strong, and again, the headline numbers were in line with estimates, but core was slightly higher. And one of the things that we've been talking about, for those that have been watching us consistently, it's all being driven by sticky inflation and services. Goods are coming down. Things are getting cheaper from that level, but the service side is the sticky piece, which is why when you look at core CPI, it's down versus February, but still it's 5.5%. And remember, year over year, that's the rate of change, where when you look at month over month, we have positive months consistently. When you look at FRB, Cleveland median CPI, you can see it's 7.2, trim mean CPI, 6.5, Atlanta sticky, 6.7. All of those being so strong is just showing that core CPI is going to remain elevated. It's going to remain a problem, which again, we continuously point to and highlight. That is where we see the biggest pressure points. Now, coming into Silicon Valley Bank, for those that have been watching, we did a show on how we thought that small banks were going to be in trouble. Here you can see that the Federal Reserve issued $297 billion over the last week. That's literally taking away almost half of the quantitative tightening that happened since April. And again, we're reaching a point of the law of diminishing returns is real, and that's why they can't keep doing more. There's a lot of financial pressure out there, a lot of concern, which is something that we keep talking to. But when you look at it, this is why we keep talking about regional banks. Regional banks are under pressure. Now, when you look at the year over year in percent, when you look at residential real estate loans driven by small banks, consumer loans driven by small banks, commercial real estate loans driven by small banks, and that is a huge problem when you look at the cumulative side, because what is their asset base? Do they have the deposits to back it? What rates is it at? And what is the bad debt expense? How stretched are these leverage ratios going to get as some of these loans become non-performing loans, which increases your expenses? your bad debt expense, which again stresses your balance sheet further. Now, when you look at it, that was on a percentage basis. Now, when you look at the cumulative purchase in dollars, you can still see that small banks they're not small in this whole situation, especially on the commercial real estate side. Commercial real estate is massive for small banks. And think about all of the commercial loans and that have started to go bankrupt. And there's a massive amount of maturity this year. So the question is, how do they mature and then turn around? And because typically what they would do is, as they're maturing, they roll the debt. But how are you going to roll the debt? Who's your buyer and at what interest rate? Which is why we continue to see a lot of pressure on that small bank side. And then when you break it down, you get an idea of that percentage on the large U.S. banks, the C&I loans, the commercial loans, but then the real estate side is still highly concentrated in the small U.S. banks, which is exactly what we talked about almost a month ago. Now, when you look at the discount window, for those that don't know, I worked on the money market desk at Morgan Stanley from 07 into 08, and you can see that just where the discount window is, it reached a new record, blowing out what happened in 2008. If you want to look at some concerns when we're showing all the different pressure points, and why we remain, why we keep and have been highlighting why the global economy is going to struggle. If anyone thinks that the U.S. financial system can come down and weaken to this point and have no contagion around the world, I don't even know. I don't know what you want me to tell you. Like, there is going to be problems. It's going to go all around, and that's going to, again, create more pressure. All the while, you have inflation remaining elevated. And this is why we've been saying from the beginning, the Fed waited too long. Everyone is looking at the Fed causing what happened right now. And this is the cure for the drug that was being fed into the system going all the way back to 2009. All we've had is zero interest rate policy, or ZIRP. We've had nothing but free money, cheap liquidity. That has consequences, and you have to undo that in order to create a normal market going forward. And that's what we have right now. You're purging the system because there is such a big problem and so much liquidity in the market that has to come out. U.S. willingness to lend to consumers is coming down, and this is for February. So this is before the financial meltdown that happened in March, to give you an idea of where we are in the system, because now we're at the point where rates can come down and banks still don't want to lend because there's that concern on how much free liquidity is going to be in the market. Now, when you look at U.S. non-residential investment and future CapEx, you can see that CapEx is coming down because companies are now looking at this and saying, whoa, what is my borrowing cost? How much money do I have available? How much should I keep in reserve in case this gets worse? So it's no surprise to see CapEx get cut aggressively. And again, that's going to lead to more GDP slowdown, more economic slowdown, more global slowdown, less ordering, less buying, less stuff moving, which is, again, why we've been talking so much about a recession and how things are playing out. Now, when you look at the U.S. leading economic index, the 11th consecutive month of it coming down. And again, this is for February. So this leading index came down prior to what we saw happen with SVB, Silvergate, and the other banks that continue to come under stress. So again, there was a big problem that is continuing to come through. And you can see anytime we've been at these levels, going back to 1981, we were in a recession, and we just hold to the fact that a recession is here. University of Michigan consumer sentiment, everything got worse. And now this is for March, but the way this index is done, they take a lot of their information the first week of March. So again, not to say that some of the financial stress didn't make it into this number, but not all of it did. So we actually expect the consumer sentiment, current conditions, and expectations to get worse in April, just because you're going to have that kind of the full panic, if you will, baked into this number as we get through the end of March, which is going to show just more consumer slowdown, more hesitancy when we look at a lot of these activities in general. So here is, again, just a lot of problems, a lot of fear when we look at what is happening. And again, these are things that we think are going to just reduce underlying crude demand, and why we've seen those pressure. We've seen additional cuts in some of the spot pricing on the physical side. We don't see that getting any better given what is happening here. And again, these are things that we're going to talk about more in more detail next week as well. So thanks again for watching. I hope you have a great weekend, and we'll see you next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.